Welcome to this deep dive. Today we're tearing apart the Masimo ticker MASI third quarter 2025 earnings call. This one dropped after hours November 4th, and well, it immediately created one of those kind of market puzzles we love to unpack here.
Exactly. You look at the results, right? And it's a clean beat. Top line, bottom line, operationally strong. And this call was really supposed to be about cementing that pivot back to their core healthcare business, after selling Sound United. Plus, they laid out this big capital allocation reset. Looked like a sure win on paper.
But that's the thing, isn't it? The paradox. And that's really our mission today. Masimo reports strong numbers, raises guidance, and the stock gets hammered, down over 4.6% the next day. So we got to figure out, why did the market sell what looks like good news? What did investors see that worried them more than the positive numbers?
Well, I think it comes down to investor psychology, really. The market seems to be weighing future uncertainty higher than the current operational success. The numbers looked great looking backwards, sure, but there were these specific headwinds, tariffs, tricky growth comps that just created skepticism about, forward visibility. And that's always poison for a growth stock, isn't it?
Okay, let's nail down those strong numbers first, because objectively it was a powerful quarter. Non-GAAP EPS, EOR 32 cents. That blew past consensus of $1.20. A solid 10% beat. And revenue, just over $371 million, also beat consensus, maybe $4 or $5 million higher, came in at 8.2% reported year-over-year growth.
Yeah, financially, you can't really fault the quarter itself, but that immediate negative stock move shifted the whole sentiment. It wasn't outright confidence anymore, more like cautious positive, if you will. The market's clearly skeptical. They want proof that these margins can drive sustainable high growth, especially given the history here.
Right. Let's talk margins then, because management made a big deal about this. 450 basis points of operating margin expansion year over year. That's a huge number. Suggests internal efficiencies are really kicking in.
Oh, absolutely. Those operational improvements are undeniable and they're paying off. But, and this is key to understanding the market's caution, you have to look closely at the gross margin. Gross margin actually went down by 70 basis points year over year, came in at 62.2%.
Wait, hang on. How does operating margin jump 450 basis points if gross margin is falling?
Yeah, it's a bit counterintuitive. It's really a classic case of external stuff masking internal wins. Management was clear, their operational improvements, factory efficiency, supply chain stuff, that added a full 70 basis points gain to gross margin. But, and here's the kicker, that was totally wiped out, and then some, by $5 million in tariff costs. That eroded margins by a massive 140 basis points. So operationally, things are humming. But those tariffs, they're very visible, very painful headwind right at the top of the P&L. Markets hate that kind of structural cost visibility.
Okay, that makes a lot more sense. Operational strength hidden by tariffs. But you mentioned capital allocation earlier. That seemed like a big part of the story, especially after the Sound United sale, almost like a safety net for the stock.
A huge part. And yeah, definitely a safety net. The net proceeds from selling Sound United were $328 million. And management didn't just sit on it, they were really proactive. $56 million went straight to paying down debt. And critically, a huge $350 million total was deployed for shareholder returns, buying back stock across Q3 and Q4. We're talking 2.4 million shares repurchased. That's them really putting their money where their mouth is on this back-to-core healthcare focus.
And those buybacks fed directly into the raised guidance for the full year.
Right. Yeah, that was the main driver, actually. Full year 2025 non-GAAP EPS guidance got raised and tightened to $5.40 to $5.55. That's a nice 15-cent bump at the midpoint. But here's where you got to look closely. Dissecting that raise gives you insight into market thinking. Of that 15 cents, only 5 cents came from actual operational margin improvements. 8 cents was purely from the lower share count because of the buybacks. And the last 2 cents, lower interest expense.
That's fascinating. So the bulk of the EPS beat and the guidance raise wasn't really from the core business suddenly accelerating. It was more financial engineering fueled by the divestiture. Is that maybe why some investors are still hesitant?
Precisely. I mean, it's an effective move. It's value accretive for shareholders, definitely. But investors, they crave organic acceleration. The market's asking, okay, great, but what happens when that buyback fuel runs low? That being said, committing $350 million, that absolutely creates a strong tactical floor under the stock price for now.
Okay, speaking of organic growth, let's look at revenue guidance. It was tightened slightly, $1.51 billion to $1.53 billion. They mentioned three things, but one sounded like, noise. A $6 million headwind from changing distributor models internationally.
Yeah, that's a key point. It's probably the right strategic move for profitability, but it just muddies the water on the top line number in the short term, creates that noise. And then there's the other big factor that likely spooked investors, the comp noise in consumables. Consumables only grew 1% this quarter.
1%, wow. For their main growth engine, that sounds pretty bad on the surface. What's comp noise mean here exactly?
It just means the comparison period was unusually tough. They were up against an unusual, quote-unquote, 20% growth rate in Q3 of the previous year, so it was a really high bar to clear. Management was quick to point out, look, on a multi-year compound growth basis, consumables are still double-digit growers, and capital equipment is low to mid-single digits. So yeah, 1% looks alarming standalone, but the context suggests it's not like demand suddenly fell off a cliff.
Right, that distinction is crucial. And if you look for underlying demand signals, they actually seem pretty strong, suggesting acceleration might be coming. That incremental contract value they secured in Q3, $124 million. That's up, 48% year over year. They said it was their strongest Q3 for contracts ever. Where's that coming from?
Yeah, that record contract value is the big counter signal to all the market fear, isn't it? It's what gives management confidence for a strong Q4 in consumables, because those contracts turn into shipments pretty directly. It's solid evidence that this renewed focus on strategic partnerships is actually working.
Okay, let's pivot to that bigger picture then. The whole back to core strategy. It seems like it's all about leveraging their tech leadership through partnerships and innovation. And the centerpiece has got to be that expanded deal with Philips, right?
Absolutely. That partnership feels potentially transformational. The goal is to really speed up integrating Masimo's core tech SCT pulse oximetry, radius PPG across Philips's entire patient monitoring lineup. We're talking bedside monitors, central stations, wearables, the whole lot.
And didn't management make a pretty bold claim about market share gains there?
They really did. They stated outright they expect share gains within that Philips installed base over the next 5 years to be greater than what they achieved in the last 5. They're essentially trying to close the gap where they feel Masimo is currently under-indexed. And for you listening, under-indexed just means they think they have way less penetration within Philips' huge customer base than their tech merits. The plan is to aggressively grab share there.
So Philips is the foundation. How are they planning to execute on that growth? They laid out 3 sort of waves.
Right. Wave 1 is commercial excellence. Basically, they've shaken up their sales teams, moved from specialized silos to more regional teams. The idea is simple. Drive cross-selling, get the pulse oximetry folks selling capnography too, leveraging those existing hospital relationships. They even mentioned a big capnography win down in the Southeast this quarter as proof it's working.
Okay. Wave 2 sounds like the really futuristic stuff. Intelligent monitoring, AML. They're aiming to launch next-gen smart sensors, AI-enabled monitors by 2026, and this connects to regulations.
Exactly. It ties directly into policy tailwinds. They already have FDA clearance for detecting opioid-induced respiratory depression, OIRD, and suddenly that's critical because new CMS rules are making hospitals report these opioid adverse events. Masimo's tech offers a direct solution to that new regulatory headache. That creates an immediate incentive for hospitals to adopt it.
And wave 3 is wearables. We know about Radius VSSM, Radius PPG. Where are those at now?
They said they're in major piloting phases globally right now, and they back this up by highlighting clinical data. Recent studies showing their SETATEC had 0 undetected low oxygen events, hypoxemia in critically ill adults across all skin tones. That's a really powerful data point. Positions their platform as superior, especially for critical care, compared to older tech, maybe tested on healthier people.
Okay, before we get to the trade idea, we should flag the key catalysts coming up. It's not just about Q4 results anymore, right?
Definitely not. The big one is the December 3rd Investor Day. That's highly anticipated. We expect them to really detail the 2026 product roadmaps and lay out that long-term margin framework. Hopefully that addresses the tariff concerns directly. After that, you'll want to watch for milestones throughout 2026 related to the Philips integration actually rolling out.
All right. Now for our favorite segment.
This is not financial advice. Just us talking about market reactions, potential scenarios based on the call. Educational entertainment only. Remember that.
Okay. So digging into the call, you see this clear mismatch, right? Stock drops almost 5% despite a clean beat, raised guidance, and that huge $350 million capital return commitment.
Yeah.
It really feels like the market is overreacting to the tariff issue and that slightly weird consumable comp number.
Yeah, the counter argument is that massive buyback program, $350 million committed, it essentially puts a strong tactical floor under the stock price. Management is signaling extreme confidence with that kind of money.
So the outrageous but plausible trade idea?
Well, the idea is to position for a rebound, basically going long to capitalize on what looks like excessive caution. Specifically, maybe think about a synthetic long using call options, like a slightly out-of-the-money call spread that expires sometime after that December 3rd Investor Day. The bet is that the Investor Day provides clarity, that they neutralize the tariff worries with a clear plan, and they really double down on the Philips and AI growth story. If they do that effectively, it could force the market to reevaluate, pushing the price back towards, maybe even above, where it was before earnings.
Okay, so let's recap the whole thing. Masimo delivered a quarter with these two strong but kind of opposing forces. We had undeniable operational margin gains from cost control, but also this massive financial boost from buybacks. They definitely solidified the strategic shift back to core healthcare, especially highlighting that accelerating Philips partnership.
Yeah, the real tension for investors is still there, though. The operational numbers were good, solid even, but the market priced in caution. That 140 basis point tariff hit was just too visible, and the 1% consumable growth, even with the context, created noise. So now all eyes are really on December 3rd for that strategic update, and then watching for execution on Philips and AI through 2026.
And here's something provocative for you, the listener, to think about. Tying back to the clinical side, management mentioned internal data showing continuous monitoring saves around $5,500 for every single rescue event prevented at one hospital. Think about that cost effectiveness. If that data holds up, how quickly will hospitals feel compelled to adopt this curb-to-curb continuous monitoring for pretty much all patients? And what could that mean for Masimo's contract pipeline over the next few years, maybe making these quarterly comp issues seem tiny in hindsight? Keep an eye on that December 3rd Investor Day for more clues. Thanks for joining us for this deep dive.